Hello, good evening, everyone. I trust that everyone can hear me. The time now is 8 o'clock and it's time for another OTCS webinar. And before we start, my name is Richard. Just a quick intro about the club. All right, so let's begin. Oops. Okay, here we go. Okay, so OTCS or Online Traders Club Singapore is a place. Oh, okay, my slide is gone. Share screen. Okay, sorry about that. Okay, now OTCS stands for Online Traders Club Singapore, and we are a non-profit society formed in 2005, and we are a community of traders and investors. And to me, OTCS stands for a place where we network, share, and learn, and we do it through a series of workshops, courses, and our library. Workshops includes webinar like the one you're attending right now. Okay, for workshops and webinar, we aim to have about 10 to 12 a year, and it is free for our members to attend. Normally, before the COVID crisis, we were meeting in person about once a month, where we will also have dinner for our members. But because of the COVID-19 situation, we have stopped the physical meeting and moved everything online. And we have also opened up our sessions to the public so that more people can get to know us and also benefit from the sharing by the speakers. Back in January, this photo is taken at SGX, and they are our sponsor for our January's workshop, Market Outlook, and it was very well attended. For courses, we aim to have about 3 to 6 a year, covering many variety of topics involving finance. And normally what we do is that we will go to certain trainers and then we'll do a group buy with them so that we can bring the cost fee lower for our members to attend. As for the library, we have about $6,000 worth of resources. And if you'd like to find out what they are and how to borrow them, of course, first you got to be a member first. Then please go to our website and go to the library section and find out how to borrow our resources. So to me, again, OTCS is a place where we network, share, and learn. And we do it through a series of workshops, webinars, such as the one you're attending right now, courses, as well as our library. So the next question is, how much? Normally, the fee is 120 Sing dollars a year, but for a time limited period only, it is just $60. So if we go back to the normal times after the COVID these measures right now and come and join us in our physical meetings where we also provide dinner. If you come for 12 sessions, I think you already gotten back your membership fee already because we provide dinner. Okay. Now to find out how to join us as members, please go to our website, onlinetradersclub.org to find out more. And also to keep posted about the upcoming free workshops and webinars that we have, please join the OTCS Telegram channel and search for Online Traders Club in Telegram and then join it, and then you'll be kept posted of our upcoming webinars and seminars. Also, you can join our mailing list, email mailing list, by going to our website, onlinetradersclub.org/mailing list, and join using your email. Either way is fine. And OTCS is not just run by the elected committee. We are also supported by a group of good friends who are members of the club who help us behind the scenes, and they are our unsung hero. And I would just like to give them a shout out and thank them for helping us all these years of running the physical events. Okay, now for tonight's session, we are going to be having our special guest, Kenny, to share with us. And Kenny also have a Telegram channel called Retirement. So if you go to Telegram and you search for REIT REMENT, you will be able to see this channel. Now, this is not a group chat, so it will not be noisy. So what Kenny does is that he will either share his analysis or tidbits of important news about REITs, and he will post it inside this channel. So currently, there are more than 1,800 people inside there receiving insights from Kenny already. So if you haven't joined this Telegram channel, please search for it and join. Now, the very important part is the disclaimer. Okay, so I got to read this. You're responsible for your own profits and losses. Speakers' opinion are their own and does not represent OTCS opinions. OTCS is office holders, associates, and sponsors are not responsible nor liable for your losses. OTCS events are for educational purposes only and should not be construed as advice. And when in doubt, seek professional help. But you know what? Tonight with us, Kenny is this professional because he is a licensed advisor to give professional advice regarding portfolio construction, REITs investment, among other things. So when in doubt, you can also ask him, okay? Now, before I hand over the stage to Kenny, I just want to talk about this thing called two paths to wealth. Okay, so after all these years of learning from and exploring many different ways to get wealth, I found that there are two paths to wealth. You either want to be the driver or you can be the passenger. You got to decide which one you want to be. Okay, so what does a driver mean? Driver means that you DIY, you do it yourself, and you will be earning active income because you are putting in effort and your time. That's why you are the driver, right? So that's one way to get to our financial objectives. Yeah, that's why we take courses, read books, and so on. The other path to wealth is DFY, and that stands for done for you. And this is a passive path towards wealth. And this is where you can be the passenger. So you got to choose different vehicles, different drivers who can lead you to your destination financial objectives, right? Now, why do I bring this up? It's because I think in life, we can choose both paths. We don't have to choose one or the others. Sometimes we can be the driver, sometimes we can be the passenger. So we can DIY and also DFY. So tonight, our speaker, Kenny, is able to share with us both ways to get towards our wealth. And if you stay tuned to the end, right? In the meantime, he is going to share with us more about REITs. And there will be a Q&A session at the end of his slides sharing. We will go into the Q&A, and somewhere along the screen that you're watching this webinar, you either need to scroll up or on the right side, you are going to see a chat box where you can type in the questions. Now, we are not going to be taking questions during the webinar, but you can feel free to type in questions along the way. Then at the end of his slide sharing, we will go into the Q&A area and we'll go through the questions. Okay, so please hold your questions until the end, and we will be able to tackle it there, and we'll ask Kenny. Okay. Now, tonight's topic is very interesting because just about 2 months ago, we had a webinar with Kenny where he's talked about the great REIT sale, because of the COVID crash. So now that we have entered into the COVID reopening in phase 2 for almost a month now, it could be timely to invite him to share with us again what are his views and insights, risks and opportunities that are available to us for REITs right now that the crash has already happened. So what do we do? Okay, so without further ado, Kenny, are you on the line?
Yep. Can you hear me, Richard?
Yes, wonderful. So without further ado, let me hand over the stage to Kenny to share with us more. Kenny, please take it away.
Okay, let me share my screen. Can you see my screen now?
Yes.
Okay, I change the setting.
Yes.
Right, how about now? Oh,
correct.
Go back again. Okay, is it okay now?
Yes.
Okay. All right, I'm going to start now. Okay, very good evening to everyone. And also, some of you know me, some of you do not know me, but it's okay. Later, I'll just do a brief introduction. Okay, tonight topic, I will is a following up webinar since the first webinar conducted on April 2nd, actually reached 3 months ago. Right now, we are talking about the phase 2 and beyond. Okay, a disclaimer first. Whatever REITs example I show here and also the data on and also analysis show here is not a recommendation to buy and sell. The other thing that I would like everyone to take note is none of the presentation here can be reproduced or copied for other personal use without the speaker permission. All right, just take note on those things. About myself, okay, basically I am currently a certified financial planner and also a REIT specialist from an independent financial advisory firm. Currently, I am overseeing a 8-figure investment portfolio. Basically, REIT is only one of the asset class I'm currently advising. There are some other asset class like the equity, private equity, and also bond, plus all those fixed income, plus all those fixed maturity fund. I'm also advising my client how to build a diversified portfolio. Besides that, I'm also a trainer for Adam Khoo, training the retail investor in terms of the reinvesting. And I am currently also the SGX trainer, panelist, and also speaker. The target audience for as a SGX trainer, basically I'm training the reminder, the dealer, and also introduce Singapore REITs to global investor. At the same time, I am also the certified REIT trainer, certifying the financial advisor, consultant, relationship manager, private banker, to certify them to make sure they know how to advise the REIT to the client properly. Okay, this is my blog, mystocksinvesting.com. You can find some of my analysis and also market outlook in my blog. Okay, I am also the panelist and also speaker at various financial events. Some of you might know, actually, I was giving the REIT 101 courses to the retail investor in the last REIT symposium. I was one of the panelists on stage to really share about the market outlook together with some of the REIT CEO. Right, and I also frequently speak at the Invest Fair organized by Share Investor over the years. These are the seminars, trainings, workshop, and interview I conducted over the years at different places. If you want to find me, there are many ways to find me. The first way is you can go to my stocks, mystocksinvesting.com. This is my personal blog. And the other place for you to find me is to go to Facebook and do a search my stocks investing journey, and you can like the Facebook fan page, because as and when I have the update in terms of analysis, I will post my link over there. Then the third place to find me, like just now what Richard mentioned, you can find me at the Telegram. Basically, as and when there are some REIT analysis or REIT news, I will post all the update there. Okay, the fourth way to find me is if you want to have a personal consultation, or you want to ask me some of the REIT related question or advisory, you can email to me, kennylaw@fapl.sg. Okay, today webinar agenda, mainly there will be 3 topics. Overview of a Singapore REIT and also the REIT performance since the market crash in March 2020. And after that, I will talk about the market outlook in terms of the technical analysis, the macro environment, and also the fundamental analysis. Lastly, I'll close up with what are the risks and opportunity, what investor can do during this market condition. Overview of Singapore REIT industry and performance. Okay, this is a quick overview of the current Singapore REIT industry. Okay, at the present moment, the Singapore REIT sector contribute about 100 billion market capitalization in the Singapore Stock Exchange. About 12% of the S-REIT market capitalization basically is come from the S-REIT. The other big percentage, of course, from the bank. There are totally 44 REITs and also property trusts listed in Singapore Exchange. And Singapore itself is the second largest REIT market in Asia. And based on the past performance, there is a 15% compounded annual growth rate of 15% over the past 10 years. This is a table to show that where Singapore rank in terms of the market capitalization globally. As you can see from here, US actually has the largest market cap in terms of REIT, the whole world, about 1.2 trillion. Right. For Asia itself, Japan is the largest in Asia, 155 billion, followed by Singapore, 100 billion. If you look at Hong Kong is just only 52 billion market cap. And if you look at the percentage of stock market, Singapore exchange itself, basically the Singapore REIT has occupied a pretty high percentage in terms of stock market cap, close to 12%. It's much more higher than, for example, the US is only 3%, Japan 2%, Hong Kong only 1%. So in short, REIT is a very, very important asset class to be listed in Singapore Exchange, and REIT is here to stay, and SGX is committed to grow the REIT over the long term. That's why this initiative and also strategy is very important to us as a REIT investor. As long as we know that SGX, MAS is committed to grow the REIT, they will put in a lot of governance, a lot of check and balance to make sure the REIT will be doing well in this region, in this country. And this is an overview of Singapore REIT in terms of market capitalization. You can see that for the past 10 years, he has been growing rapidly at a CAGR of 15%. Moving forward with the commitment of SGX is expected to grow over the long term. That's the reason that probably we'll be seeing more and more REIT coming to Singapore to do the IPO, or maybe some of the domestic-owned REIT like Mapletree, Ascenders, they may be converting more private REIT to the public-listed REIT moving forward. This is the past 8 years performance based on total return. Total return is equivalent to the index capital appreciation plus all the dividend to be added out together, right? Over the past 8 years, if you can see from here that if you are the investor invested 10,000 in 2112, after the 8 years, your total capital of 10,000, you grow to 25,000. Right, 250% growth, right? That's represent about 12% CAGR over the past 8 years. During this market crash, actually represent a very good opportunity for the investor to really buy the REIT at a huge discount. Because if everything to be recovered, it is expected the total return you go back to the normal trend and grow at 12% CAGR. Okay, if you look at the FTSE REIT index versus the STI, why REIT is a very good asset class to hold for the retail investor in Singapore? Actually, retail investors should not miss REIT in your portfolio, right? I plotted this three index over the past 10 years. If you look at the STI is indicated in the purple color. For the past 10 years, just purely based on the price index, actually STI is at a negative. Okay, it's basically if you invest STI index for the past 10 years, you're still losing money. Of course, over the years, you still can collect a dividend about 4%, right? But for the REIT itself, REIT is the best performer over the past 10 years. Is the performance even better than the financial sector, right? This chart will tell you the whole story. If we compare to other region for the last 5 years, okay, FTSE ST REIT index represent the Singapore REIT sector, and ASX is an Australia stock exchange, TSE is Tokyo Stock Exchange, and also Dow Jones REIT index, right? If you look at the past 5-year performance, S-REIT actually outperformed the rest of the exchange. They grow by 78% compared to 35%, 51%, and 24%, so on and so forth. And for the year to date, 2020, actually, when the market crashed itself, actually Singapore REIT is actually the most defensive compared to the rest. That's why you can see the drop actually not as severe as other exchange. This is the REIT performance comparison for those listed in the FTSE EPRA 9 REIT developed REIT. There are total about 14 REIT listed and also included in this index. Okay, let's go through the number one by one. It's pretty busy on this table. Okay, I just want to navigate through so that you understand how to read this table. In terms of yield itself, from these 14 REITs, the average yield is about 5.8%. Okay, compared to other region, basically it's quite good, not bad. Okay, and based on the year-to-date performance, after the market crash, and actually Singapore REIT rebounded very strongly, it's only minus 5.33. For the past 3 months, the rebound about 30%. If you compare to other region, right, compared to Canada REIT index, year to date still minus 21%. US REIT is still minus 20%. Australia still minus 29%. It still has not recovered fully yet, although Australia REIT sector rebounded the strongest compared to other sector, rebounded about 17% for the past 3 months. And Hong Kong REIT still at negative 21%. Japan minus 21%, right? New Zealand minus 38%. All right. So based on all this data, in short, Singapore REIT is the star performer, right? They basically rebound the strongest, and at the same time also beat the performance beat the rest of the exchange. Okay, so during this rebound period, the market crash actually happened at March 23rd. That was a market bottom. Since the market bottom on March 23rd, S-REIT has already rebounded strongly, close to 40%. You can see that based on this comparison chart itself, REIT close to 40%. The bank stock is about 25%, followed by the STR is only 70%. So no doubt, S-REIT is a star performer even in the Singapore exchange. So I will summarize this the S-REIT performance into this slide. Later I will show you some of the numbers. So Singapore index has rebounded close to 40% since the market crash in March 2020, and the big cap actually led the rebound. Later I will show you the market cap, which are the big cap led the rebound. And year to date, there are total about 1, 2, 3, 4. There are 4 REITs. Capital DC REIT, Mapletree Industrial Trust, Mapletree Logistic Trust, and also Ascender Trust. Year to date, they are either have a perform very well, and even some of them they are breaking new high. Okay, and also industrial sector, the best performing REIT sector during this period. Okay, I will show you in terms of market capitalization, right? Which sector has was the best performance? Okay, during the past 7 days, right? Basically, not so significant. Ascenders was one of the best performers, increased by 0.61, and also Capital DC 1.93. Right, for the last 90 days. Okay, 90 days, that means is pretty close to the market crash. You can see from here that most of the biggest rebounds is coming from the big cap. The bigger the rectangle or bigger the square represent the bigger the market capitalization. You can see from here that Ascenders REIT has a market capitalization of 11.9 billion. The last 3 month performance, the rebounded at about 16.2%. And you can see from here, Mapletree Logistic, the market cap is about 7.7 billion, 17.75%. And Mapletree Industrial was a star. Total market cap 7 billion and a change 21.49%. If you compare to the year-to-date performance, okay, year-to-date performance again led by all those big cap. Also, there are many industrial REIT. Ascenders REIT are the industrial REIT. Mapletree Industrial REIT, Mapletree Logistic and Industrial Trust are the industrial REIT, and Capital DC is a data center, okay, and also can classify as industrial. So you can see that actually the whole industrial sector led the rebound, and the rest year to date they are still lagger, okay. And surprisingly, you can see the Escort trust over here. Escort actually is from the hospitality sector. Actually, they also rebounded quite strong. They almost break even compared to the beginning of year. It's only minus 3%. And there are many REITs over here. Until today, they are still not fully recovered yet. Okay, is it a bad news? To me, it's not a bad news, which means that there are still a lot of opportunity available because most of them, they are still not back to the previous high yet, or even close to the previous high. So market outlook. Okay, on April 2nd webinar, I share about a 3 different scenario how the market can play out. The first scenario is I mentioned that will be probably a V-shaped rebound. Okay, V-shaped rebound. After that, followed by the rally, right? And what we need to watch is this higher high and higher low chart pattern, right? That was the first scenario. The second scenario I share on April 2nd will be the U-shape plus consolidation. Basically rebounded a bit, and after that start to have a ding dong here, moving sideways for a while before they go higher. So in order for this chart pattern to be formed, we are watching for the double bottoms or triple bottom takeout pattern. And the third scenario was share after the rebound, and we have a further sell off because of the COVID-19. We do not know what is the impact, and there are a lot of fear in the market. There may be a further sell down. All right. After based on this 3 scenario, now coming to 3 months, okay, the actual fact at the present moment is a V for S REIT. Okay, at for the time being, is the V-shaped rebound. It's a clear V-shaped rebound, and at the same time, this current trend is referring to the uptrend. It's going up. All right, there is no bearish signal here at all. It's a bullish REIT market. So moving forward, what would be the trend? Based on the chart pattern itself, okay, the current REIT index is forming a symmetrical triangle. Okay, forming a symmetric triangle. At the same time, this REIT index is sandwiched between the 200-day moving average, represented by like declining green line, and also the 50 days simple moving average. Is sandwiched between these two moving averages. Until the breakout is expected, the REIT index will be moving a sideways. Okay, of course, during this period will be very volatile because the earnings season has started, right? We expect you'll be going up and down within the range, unless there will be a very bad news or big news happen. I don't see any possibility that in the near term the new trend will be formed. It may go up after breaking out from this symmetrical triangle, and it may come down. So until then, unlikely we are able to make any decision in terms of direction. Next, I will show about the macro environment. I've shown this slide in the last webinar. Okay, basically I show that what COVID-19 will affect the whole world moving forward. By then, I'm not going to go through the whole slide itself. If you want to read what's the impact, how it affect, you can go to YouTube and watch on the April 2nd REIT webinar. All right. Okay, I want to touch on this company default. Right, everything play out as per predicted. Right, everything stalled, and after that, cash flow stopping, the supply chain disrupted. There are no spending, and business continue to burn cash, and also economic recession is now is on the table. Is happening now. Okay, by then, still predicting, now it's already confirmed all this thing has happened. Now the next thing is happening now is we start to see company default. The impact will be much more severe in these 2 quarters, that means second half of the year. Now you every day you read the newspaper or read the internet itself, you are seeing that more and more company default, right? Now the next thing we have to watch whether this company default, you end up to the domino effect on a debt default. When the huge debt default and the domino start, and it may cause the whole financial market collapse. Okay, that's the thing that we need to watch closely, and before deciding the next step, right? But as long as everything is under control on a common default side, I think that the market may continue to move higher. Who knows? Okay, later I will share what are the reasons why the market may be continuing to move higher. Okay, this is a slide. You can see that actually bankruptcy is on the rise. Okay, and you can almost every day you are seeing the negative news. Okay, but although you are seeing the negative news, the market don't have any sell off. Okay, which means that there are something they are still really supporting the market pretty well. You can see that also IMF has already adjusted the forecast in 2020 is a huge recession globally. And if you look at the JP Morgan, the Purchasing Manager Index PMI, basically most of the country they are in negative range, right? Is in the contraction range. PMI more than 50 it represent is an expansion, right? Less than 50 is a contraction. The further away from 50, the more severe is a contraction. That's why at the present moment, based on the May 2020 data, only China we start to see some expansion. Oh, what is supporting the stock market rally? Although we are seeing a lot of negative economic news and also very lousy the kind of PMI data. Okay, basically in short that the Federal Reserve print a lot of money. It's a money printing. We have the QE Unlimited, and also we have the virus rescue package, stimulus package issued by all the country, and also we are currently living in the ultra low interest environment. So the first round, the bear won the first round. The second round, the bull are still leading. Okay, and the bull still going strong for the time being and is holding pretty well. This what we can see from a chart itself. Dow Jones Industry basically is on the bullish uptrend. This is an uptrend and very bullish at the present moment is forming a symmetrical triangle, is a consolidation period, consolidation pattern. And S&P 500 is also a clear uptrend. Okay, it's going to break the recent high very soon. And then down and for the Nasdaq has already hit the new high. And so far the trend is still pretty bullish. All right. If you have invested after the market rebound sometime in March, your technology portfolio should be making about 40 to 50% of profit by now. Fundamental. So what is the S-Street yield comparison for the time being? And based on the data itself, the average yield for the 44 S-Street and also property trust listed in the Singapore Stock Exchange at the present moment is about 7.1% compared to the STI index 4.9%, and MAS 10 years government bond is about 0.9%, and fixed D is about 0.5%. And if you look at the recent Singapore saving bond, actually the yield dropped a lot and it's pretty pathetic. It really does not really make sense to hold too much cash for the time being because under the low interest environment, our purchasing power will be eroded. Okay, and you can see from the SG 10 years government bond yield and also US government bond yield is coming down. It keep coming down, and it is expected to stay low for the next few years until the economy recover and the inflation start to come back again. So in short, that moving forward, I am expecting a very low interest environment, and a low interest environment actually will give a good support to the property sector. Okay, there are two charts over here. On the left hand side is a yield spread of FTSE ST REIT index. Okay, I'll go through slowly to so that everybody understand how to use this chart. Okay, on the y-axis itself, basically is the yield. Okay, on the x-axis, basically is the day. Okay, if you look at the blue line represent the FTSE ST REIT index forward yield, forward dividend yield. Okay, moving forward based on the current price. Okay, the FTSE REIT index will give you a 6% yield. Okay, for the investor, right? And the yellow line represent the Singapore 10 years government bond yield. You can see that actually the bond yield is coming down. Okay, it really makes sense to really move the money from a Singapore bond yield. Okay, because there's no yield over there to really invest in something which has a higher yield. All right, and the difference between the REIT index and also 10-year government bond yield, we call it as a yield spread. Okay, at the present moment, yield spread is higher than the historical average, about 4%. Okay, in other words, in layman term, based on yield spread itself, the current REIT sector is attractive. Okay, this is layman term. Okay, on the right hand side, we compare the yield and also the price to book value. Okay, this is the blue color represent the FTSE REIT index current TTM yield. Current yield is about 5%. And for the green line, this represent the price to book value. Okay, price to book more than one is overvalue, less than one is undervalue. At the present moment, the price to book value is close to 1. Okay, but if you look at the previously during a market crash, actually a price to book actually traded 1 standard deviation away. That's why actually in March itself, during the market crash, there's the best time to enter the REIT sector, because in terms of valuation, REIT sector is pretty cheap. Okay, at the present moment, all in all, in terms of average, about at a fair value. Average dividend yield by sector. Hospitality sector at the present moment give us about 8%. Okay, pretty attractive. But of course, there are also risks inside. Okay, moving forward, they may be facing a dividend cut because of the hotel shutdown, the airline shutdown, and those things. So just bear in mind that all the yield presented here, they are trailing 12 months. It's a lagging indicator. Healthcare 7.9%, diversified REIT 7.6%, office 7.2%, retail 7.1%, industrial 6.3%, and specialized REITs refer to the data center. The yield is only 3%. Okay. And currently there are many REITs which have a very high yield. I'll show you what are the REITs have a very high yield and also undervalue. This is the two most important so-called financial ratio at the present moment. Okay, in terms of yield, I rank from the highest yield to the lowest yield. Okay, we exclude forget about the Eagle Hospitality because this one is already suspended. The highest yield TTM yield at the present moment is a Lipo Mall. Okay, followed by First REIT 11%, and also ARA Hospitality Trust 10%. You can see that actually plenty of them, the yield actually more than 6% or more than 7%, right? The lowest yield at the present moment, right, is the land lease. Okay, but of course, land lease is just newly IPO. We still need to wait for more data before we can determine what will be the annualized yield. But a Keppel DC is only 2.88. Right, the yield spread is only 1.98%. Actually, in other words, Keppel DC is pretty expensive, and also the yield is also not attractive for the Ascender Street. Okay, just take note. This is the TTM yield, right? During this period, because of the dividend cut, that's why the yield will drop. For investor, if you want to analyze REIT at the moment, you should not use yield as the only financial factor, because if you use the yield as the only financial ratio, you miss out a lot of opportunity. What we need to take a look is to the forward yield. Okay, after the COVID-19 over, what would be the yield under the normalcy? Okay, in terms of the price to book. Okay, price to book. I repeat again. Price to book less than 1 is undervalue, more than 1 is overvalue. You can see there are plenty of them currently undervalue. At the same time, you can see from here the price to NAV 1 year and 5 year, they are trading on the lower range, okay, which represent very attractive. For those REIT which has a very high price to book, for example, Keppel DC about 2.3, pretty expensive, and Maple Industrial is 1.98, Maple 3 Logistic about 1.77. They are trading at historical high. You can see the price to NAV actually at a historical high. Okay, this represent they are pretty expensive for the time being. So in summary, S-REIT second half 2020 outlook. From a macro perspective, we are under the ultra low interest environment. And also, the US Federal Reserve printing a lot of money, QE unlimited. And because of the low cost of capital, that will encourage the growth for the REIT itself through all the merger and acquisition. Okay, through the merger and acquisition, the REIT will become bigger and bigger in terms of market capitalization, and their DPU yield is expected to grow over the long term. Okay, these are the positive news for property sector, especially REITs. Fundamentally, some REITs are still cheap, but the NAV may drop in the short term. Later, I will explain why. And it is expected the dividend will be cut in the next 2 to 3 quarters. And we also expect a downgrade in credit rating. In terms of technical, the current FTSE REIT index has already rebounded strongly in a V shape, and currently is in the consolidation mode, waiting for a breakout. So until the breakout, we are unable to determine what will be the future direction. But based on the macro and also fundamental, my view is I support the breakup to upside, which means that the bullish trend to be continued. Okay, so what would be the risk and opportunity in the current market environment? Okay, let's go back to the fundamental of a REIT investing. All right, recap why we want to invest REIT in the first place. Okay, when we want to invest REIT, we are expecting to receive the regular dividend payout by owning a REITs. Okay, REITs is also as an alternative to the physical property investing, and the objective of holding a REITs and also time horizon in holding a REITs basically is a medium to long term. REIT investing is never be the short term. Okay, it's on for the long term, so that we use time and to wait for the dividend payout. And when everything become normal again, under the economy go back to normal again, basically we expect the REIT will provide a stable passive income either half yearly or quarterly, right? And also because of this, the underlying is a physical real estate, is expected the real estate value will go out over the long term. That offers the potential capital appreciation to the REITs. Okay, the REITs model, just go through how they borrow the money to buy the property. Okay, basically there are two forms of the capital capital raising. Okay, they either borrow from a bank or they raise a fund from a shareholder. After raising the fund, they're going to buy a property. Then after buying property, whatever rental income coming back, paying off all the interest expense and all the working capital, the remaining 90% have to pay out as a dividend. Okay, so what will be the risk? The risk at the present moment, okay, probably most of you already know that. Okay, basically it will be a rental income, right? The risk basically is coming from the tenant default and also master lessor default, right? When they default, then if the underlying property itself is a secure borrowing, that means they pledge the property or to the creditor. If they are not able to pay the coupon or bank interest, okay, they'll receive the notice of default. Okay, this happened to the Eagle Hospitality Trust. Okay, because they are not able to pay a coupon, that's why they end up they receive a notice of default, and Eagle Hospitality Trust at the present moment is suspended. Okay, and in terms of dividend side, we already seeing that there are many REITs actually cut in dividend. They are holding all the cash. They delay the dividend payout, and because of the cut in dividend during this period, okay, probably in the next few quarters, the NAV is expected to drop. because the property valuation is very much depends on the discounted cash flow model when it comes to the doing the valuation of a property. Okay, and at the same time, the gearing ratio is expected to increase. I also already see that some of the REITs, the gearing ratio has already increased, and when all the so-called drop in NAV gearing ratio increase, basically the fundamental based on the balance sheet itself will be weakened, and this will lead into the next thing to be credit rating downgrading. Okay, if the credit rating being downgraded, which means that some of the fund manager, they will do the portfolio rebalancing by selling some of the holding in the REIT itself. Okay, those are the risks. Okay, and also Singapore government actually come out a series of support to support the REIT sector. Okay, one of them is they increase the gearing ratio from 45% to 50%. Okay, the reason being is they are already in anticipate the gearing ratio will increase. If the REIT close to 45%, they are not able to really borrow more money to help their cash flow management. Then if they want to increase their liquidity, they will force to go to the equity market to raise cash by issuing more right at the wrong price, at a depressed price. That will make the whole REIT sector even worse and create more panic. So by increasing this gearing ratio from 45% to 50% actually help REITs a lot because they have much more debt room to really borrow and so that to tie through during this period. And at the same time, MAS also allowed the interest coverage ratio to be deferred to January 2022. Okay, and IRAS coming in to also allow the distribution of a taxable income extended to 12 months. Okay, which means that during this the initial financial period, probably in the Q1, Q2, the REIT can hold back all the cash, and they can then hold back all the cash not to pay out dividend, at the same time not subjected to a 90% payout rule. They can wait until the year end and distribute their dividend at one go. Okay, at the same time, there are several measures like temporary relief for the tenant and also inability to perform the contract, those things to really help a tenant. And there are also the bill passed in the parliament for the REIT or the landlord to really offer the rental rebates, rental waiver, plus all the property tax rebate. Okay, so all this government support actually help the REITs and also help the tenant, the whole ecosystem. The more important thing is we need to make sure everybody survive. Okay, so that we can overcome this period. It's no point that we kill the goose. Once the goose is killed, that means the golden egg you will not be laid. So, what is important criteria to invest in REIT during this period? So, not all the REITs are strong. The ability to survive is crucial for Singapore REIT. Okay, that investor have to pay special attention. Thus, so during this period, actually the selection criteria has to be modified. Okay, to be suitable to the current environment. The three important thing to look at REIT, additional key parameter to look at REIT is ability to generate positive cash flow. Okay, we can look at the interest coverage ratio to determine whether they are able to generate enough cash flow to pay for all the obligation, and also ability to refinance a debt, plus the percentage of unsecured debt are important, right? Okay, I will show you some of the REIT that have very strong financial they have a strong ability to generate a positive cash flow by looking at the interest coverage ratio. Okay, the REITs has the highest interest cover ratio, actually Parkway Life and also Keppel DC. That's why no doubt, okay, because they are pretty strong financially. Okay, that's the reason that actually they are breaking all-time high now. Okay, Parkway Life and also Keppel DC. Okay, this one of the so-called ratio we need to look at. Another thing is unsecured borrowing, right? Because we do not want the REIT actually pledge too much on their property to borrow the money, because if they are not able to really service all the coupon or bank interest itself, there is a risk that the property will be repossessed. So unsecured borrowing also important. And what will be the opportunity? Okay, and also the opportunity for the REIT itself, for those REIT has a very high interest coverage. Okay, that represent an opportunity for them to really do the debt refinancing, because when they're able to do the debt refinancing to a lowest interest rate, in other words, their DPO will increase, right? So ability to refinance is important during this crucial period, and also that also represent an opportunity for them to perform well moving forward. So opportunity, what are the opportunity? When we come to reinvesting, if your time horizon is long term, this COVID-19 market crash represent a very good opportunity. But if the investor have very short-term period, okay, only focus during this COVID-19, maybe the time horizon only maybe 3 months, 6 months, this is not really good for those short-term investor or short-term trader, because during this period you'll be very volatile. You'll be seeing a lot of negative news, and this negative news will cause a lot of knee-jerk price action in the stock market itself, and you probably is not able to sleep well by holding the risk. Okay, but if you have a long-term view in terms of REIT investing, okay, after this COVID-19, when everything back to normal, assuming you are holding a very strong REIT, okay, REIT with a strong fundamental, and at the present moment, because everybody panic, they are trading at a discount to the historical value, and the REIT itself, they have a very strong sponsor, they have very clear long-term growth potential. Moving forward, those strong REIT will become stronger and bigger, and at the end of the day, the valuation will continue to grow and dividend will be continue to grow. Okay, so under this macro environment, like I said before, you give a very good support to the REIT sector because of the ultra low interest rate environment. We have unlimited QE, and also they are too cheap for the time being. The too cheap money and also cheap valuation. This is a very best time to really go for aggressive acquisition. Oh, holding a REIT is basically holding a diversified property, right? So REIT allow the investor to own more than 1,000 property globally without with minimal hazard. So this is an example of holding all Singapore REIT portfolio. If you are owning all the following REIT, basically you are participating in the whole Singapore economy, because all these REIT based on the combination itself, you have a shopping malls, you have a hotels, you have offices, logistic, industrial, data centers, so on and so forth. Okay, and total we have about 453 property have already under the REIT. So owning a Singapore REIT portfolio, okay, the good reason is basically in Singapore itself, politically we're pretty strong, and also stable. We have a clean and also credible government. And internationally, we have a neutral stance. We don't bias to China or bias to US. Okay, it's neutral. It's good for the investor to really come to Singapore to park their money over here. And also, we have a AAA sovereign credit rating. This will help the stability of a Singapore dollar. And also Singapore as one of the global financial hub and also wealth management center, we have a very transparent and also complete legal system, well regulated wealth management and also financial service system. Plus, we also have a very strong corporate governance. Investing in Singapore REIT, basically, we will be participating in the economic growth in all aspects. Okay, participating in the Singapore long-term economic growth and also economic transformation. If you still believe in Singapore, right? I strongly believe in Singapore. Okay, and also at the same time, you're also investing in the property sector in a land scarce small little island. Okay, Oh, this is another example that if you hold the following REIT, basically you can own the whole Orchard Road, right? Okay, you can take a look. If you have time, you just walk from Tanglin and all the way to maybe Dhoby Ghaut or Bencoolen. Okay, you just walk all the way from Tanglin to Bencoolen. Okay, definitely you pass by 3 MRT or 4 MRT. You should be able to see a Gleneagles over here. Gleneagles belongs to Parkway Life. Okay, after that you see Orchard Hotel. Orchard Hotel is under the CDL Hospitality Trust, and Wisma Atria under the Star Hill Global, Mount E under the Parkway, and Paragon under SPH REIT, and Mandarin Gallery under OUE Commercial Trust. Land Lease 313 Somerset belongs to Land Lease. You also have Ascot Orchard, Ascot resident over here. Okay, Plaza Singapura belongs to Capital Land Mall Trust, and and the Penang Road, 9 Penang Road, if you still can remember, is under renovation. I think that next year probably you'll be ready, or end of this year to be ready. Okay, actually 9 Penang Road belongs to Suntec, and you have a Randover Hotel is under the Far East Hospitality Trust. Okay, basically this is the Orchard combo. Okay, up to you to choose. All right. But if you want to have a more diversified portfolio, you want to diversify to US, all right, there are quite a number of REITs over here in US, 162 property under this REITs, okay, and also in the Europe, you have plenty of option, total 414 property in the Europe portfolio. And if you like Australia very much, you do not want to go to Australia to invest in a physical property, you can access to the Australia property sector by investing into REITs. Okay, totally easily you can own close to 1,000 property. So it's very easy to own 1,000 property nowadays. You do not need to invest in physically in overseas. Just buy all the REITs in Singapore. You should be able to become a 1,000 property owner. Oh, this is a chart of a 20 years annualized return by different asset class. Okay, why REITs? I strongly believe in REITs, and I strongly recommend REITs in our retirement portfolio. That's the reason I create a Telegram chat, retirement. Okay, because if you look at the past performance, past 20 years performance from 1999 to 2019, the annualized return for the REIT itself is 11.6%. Okay, this is referring to total return in terms of capital appreciation plus all the dividend add in. Okay, compared to gold 8.6%, S&P 500 6.1%, and the bond 5%, and oil, home, inflation, so on and so forth. So REITs has the highest annualized returns compared to other asset class for the past 20 years. So risk and opportunity, after I've shared so much, okay, what should the investor do? Okay, there are just too much information. At the end of the day, we just need to digest the information and also make the investment decision. Okay, the summary of the risk and opportunity. Okay, the current ultra low bank interest rate is expected for the next few years. Okay, and if we just let our money idling in the bank, there will be a very high risk of the eroding purchasing power due to the inflation. Okay, and currently the earnings season just started, and we already seen that CDL Hospitality Trust and Escort Hospitality Trust, they already issued a profit warning, and most REIT will probably report very ugly. Okay, I'll use very ugly this word, quarter earnings. Okay, moving forward. Okay, by the way, all this has already been priced in. No surprises. Now we are just need to wait for the earnings result to see how ugly the earnings to be, right? And definitely, due to some of the weak heart investor, they'll after they see the ugly result, they'll panic, they will sell. Okay, that's why probably there'll be knee-jerk reaction to the share price. Okay, but is it a bad thing? It's not a bad thing, right? Knee-jerk reaction, panic sell is a good opportunity for those smart investors to get in, okay, provided you know what to buy and what to choose and what price to enter. So long-term wise, Singapore REIT, you continue growth, and the growth you accelerate under the ultra low interest environment. If you read the news for the past few weeks, you have we probably can see that actually Ascenders REIT started to start acquisition. Okay, Maple Tree Industrial Trust also have some acquisition. Okay, if you go back, you can see all those big cap REIT with very strong sponsor, they have already started their shopping. Okay, that will continue to grow their portfolio size and also the market capitalization. So investor, for REIT investor, if you want to identify opportunity, okay, must have a long-term investment horizon. And if you believe in REIT, whatever thing you invest now, especially during this period, you have to look beyond the current recession. Definitely recession, you'll be here for the next few months and you feel very uneasy, okay, because whenever you every day whatever news you read or whoever person you talk to, you'll be negative. That's why mentally uh, uh, and also your heart must be very strong, so that you can ignore all the noises and also focus on your own investment. Okay, and lastly, good and cheap REITs only available when other people in panic mode. Okay, the key question is whether you can identify those opportunity and also take action. Okay, more importantly is to take action. I have given the radio interview in March after the market crash, and also my webinar in early April. Okay, during the interview and also webinar, I keep mentioning that it's a good time to enter. It's a good time to enter. But to tell you the truth, even I advise to my client, not all of them have a guts to enter and take action. So analyzing the market is one thing, and identify opportunity is one thing. But if no action to be taken, basically it's just nothing will happen. Okay, the wealth will not be grow. You're not going to make any money. Your retirement plan will not be affected. Okay, so the most important thing is to take action. So what can an investor do? Right? I have a few solutions, okay, for you to consider. Okay, the first one, what I can offer is to the DIY investor, okay, you need to equate sufficient knowledge to capture the once in a decade opportunity. Okay, I have been investing REIT close to 9 to 10 years already. Is the window of opportunity for REIT is pretty small, right? Because REIT is a well sorted asset class. There are many Singaporean and also investors that really like the Singapore REITs because at the end of the day, it's a real estate. At the same time, the yield is pretty high compared to other asset classes. Okay, so whenever there is a huge market crash or the big correction, normally those big cap REIT will rebound very fast. Okay, so if you want to understand and also learn how to invest in REIT, my next REIT webinar course will be this coming Saturday. I only conduct this kind of webinar courses to the retail investor once in a quarter. Okay, at the present moment, my focus is training all the professional in terms of reinvesting. So you can go to my website, this link, mystockinvesting.com, course Singapore REIT, and there's a promo code there. You enter the promo code, you'll be having the discount to register for this Saturday course. Okay, for some of you who are my past student, you would like to receipt because I have tweaked some of the selection criteria, okay, to capture the current opportunity, right? You would like to receipt, please send an email to events@mystockinvesting.com, and more importantly, you have to attach a previous course registration detail, indicate in the email when do you attend, and also show us a date, and we'll give you a promo code for the receipt. Okay, for those investors, you find that okay, if you want to go through the whole course and also do all the analysis, do all the homework, and by the time you finish the whole exercise, whole course, finish all the homework, you already missed the boat because the market has already gone out without you. And if you want to kickstart your portfolio by skipping all the steps, okay, shortcut, and you can outsource to me. I can help you to do everything under the advisory arrangement. Okay, so if you need my help to invest your current investment portfolio, to give you some advice what to do you restructure, should you restructure the current portfolio, or you need my help to really take over your portfolio to help you to manage. Of course, I restructure a portfolio based on my own understanding and also my knowledge, right? You can send me an email to kennylaw@fapl.sg. All right. So I think that would be my last slide, and that's all. Thank you very much. I will hand over back to Richard so that he can host the Q&A.
Yes, thank you very much, Kenny. Wow, that is a very intense 1 hour that you covered the topics that for the webinar. Thank you so much for your sharing, Kenny. Yep. So I will now open the floor to questions. And for those of you who are inside the webinar room and you have questions about REIT that you would like to ask Kenny, please type into the chat box somewhere on your screen. If you're on a computer, it should be on the bottom right-hand corner. And if you're on your mobile devices, then you probably have to scroll up or scroll down, and then you will see the chat box there, and you can type in all your questions there. So while we are waiting for the questions to come in, maybe I'll just ask a few questions myself first. Kenny?
Yep.
Actually,
Sure.
Kenny and I went back quite a long way when I first want to learn about REITs investing. So what I do, what everybody do lah, right? Which is to Google, and lo and behold, his blog came out. So then I, because of my busy schedule, I wasn't able to attend the classes that he conducted back then for quite a number of months until I found a slot that I can go in, and then I quickly went to attend. And then after I attended, I absolutely love it. So the foundation of my own REITs investing portfolio came from Kenny. So big thank you to Kenny. That's 2014年很多年前哦。
Very long
Yeah.
time ago.
So yeah, time flies, time flies. Yeah. So just now at the beginning of the webinar, I mentioned that there are 2 ways to achieve our financial objectives, right? So if you want to include REIT in your portfolio, then there are 2 ways. One is that you can DIY, you can learn all you need and then do it yourself. You'll be the driver, and that's your active way of earning your returns from REIT. Or like what Kenny has said, if you have tried to do it yourself and you couldn't pull the trigger, or you couldn't get the kind of returns that you desire, then you can outsource to Kenny to handle it for you, and that's the DFY model, and that's passive. So you just be a passenger lah. So you hop onto Kenny's REITs car or aeroplane or rocket. All right. So to find out more about how all this can be done, please contact Kenny in the mode that he has shared with us just now. So for those of you who have questions, please go ahead and type into the webinar room. And we have over 300 people watching on YouTube, Kenny. So if you are over
500.
watching YouTube, there is about 10 space in the webinar room. Some of the attendees in the room has left. So if you have questions and you're watching YouTube, please feel free to come inside the webinar room to ask. Okay. So just now, Kenny also mentioned about the webinar that he has conducted back in April the 2nd, where he talked about a great REITs crash, right? So if you want to watch the webinar and see what was the insights that he has shared and how it has played out, very simply, you just have to go to YouTube and search for Wealth and Joy, and you will see, and then click on video. You will see COVID-19 crash, right? Risk or opportunity to hold REITs. So you click on that and you'll be able to see the webinar that was held on April the 2nd. And then you connect the dots from what he have shared to whether it has played out today. And then now that you have attended the webinar today, and he has shared about where Singapore REITs might be going in the coming months, things getting ugly, things getting cheap. What are you going to do? Right? Do you know what to do? If you know what to do, then go ahead. If you don't know what to do, then please contact Kenny for help. Okay? So now let me take a look at the questions.
Yeah, I've seen some question.
Yeah, seen some questions. Okay. So
okay, I can start answering those.
yes,
right?
Ken,
Okay.
go ahead.
Yeah. Yeah, Liner asked about the if Ascendas India Trust is not a REIT, why does it mean to keep paying out at least 90% of profit every year? Okay, basically, if this is not REIT itself, there's no requirement for them to pay out 90%. This is basically based on the management discretion, right? So Jack asked about, will office REIT occupancy be affected in the future by impact of the working from home? My personal view, definitely telecommuting, you have some slight impact to the office itself. But short term wise, I don't think the impact will be great because the weighted average lease expiry is still pretty long. And when the lease agreement is a legal document, they cannot just terminate the lease agreement. Is like that, right? That's why those corporate, they can only review the lease agreement after the lease matured. Okay, and also my another view is for those banking sector and also asset management sector, which deal with a lot of customer confidential information and also those proprietary trading system itself. I think that working from home may not be a so-called major trend moving forward because on the cybersecurity, right, and also confidentiality, right. It is a challenge for the IT team and also the infrastructure team to really make sure when the employee, when they work from home, they will not be attacked by all those cyber threat, and also they are not going to leak all the customer confidential information. Okay, because the consequences you'll be huge for those information being leaked itself, right? So in order for those corporate, they want to encourage the employee work from home, they definitely need to invest in a lot of IT resources to make sure everything is under compliance and also under control. So that can be maybe another additional cost. That's why if I'm looking at this perspective, I don't think there will be a mass shift to really working from home, okay, because of all the cyber security issue. Okay, and I don't know how to pronounce this one, PYOE, pure. Okay, would the recession news have any impact? Okay, okay, first of all, if you look at the stock market performance, they are basically nothing to do with the news and also recession. And stock market always move 6 to 9 months ahead, right? So that is that's why if the investor every time continue to look at the current market noises or those news to make the investment decision, probably you have already missed out a lot of opportunity in the market. Okay, stock market and also the economic, they do not move together. Okay, stock market movement normally 6 to 9 months ahead. Okay, so probably hopefully you can learn something. You don't look at all the news itself and also make your investment decision. Okay, because based on the recent data, market rally is already stated very clearly. Even the COVID-19, the whole world pandemic, but the stock market continued to rally like nobody business. There are a lot of other factors like the monetary policy, QE, that kind of thing. You affect the stock market itself. Okay, when is the earnings coming out? I think last week, SPH REITs has already announced the first earning. Moving forward, now it's already in July. That's why for the next few weeks, you should be able to see a lot of news coming up. Okay, so it's expected the market will be very volatile. For example, 2 days ago, when the news come out that said that Escort Hospitality Trust and also the CDL Hospitality Trust, they have a big impact on the revenue and also the so-called the profit itself. There's already knee-jerk. I think yesterday Escort dropped by about 3% and today dropped about 1%. Anyway, the drop is not really significant. It's not really huge. So you expect all the knee-jerk during this earning season. Okay, so be positive if you are able to identify a good one. Any knee-jerk impact and any negative result, you can see some sell off. Maybe it's a good time for you to accumulate. Okay, Jack asked, can we get a slide? Sorry, you can refer to the YouTube. The slide will not be distributed. Okay, Jack asked about which sector is currently the best to invest in. Based on the valuation itself, the most attractive sector at the present moment is a hospitality trust, hospitality sector. Okay, the reason being is because most of the property or hotel or resort, they are selling at huge discount. The discount can be up to 30% to 50%. You just imagine uh, a hotel at a very good location, a premium hotel selling at 50% to the value itself, right? Of course, it's very attractive in terms of valuation. The key thing is whether you have a guts to really go and buy, because over the short term, maybe 1 to 2 years, you are not going to see a lot so-called visitor or a lot of tourists coming back that will affect your income. Okay, but if you have a long-term horizon, maybe you're investing for 10 years, 20 years, actually all this short-term volatility is does not really matter. So whether it's an investment opportunity is very much depends on the objective and also your investment horizon. Okay, that will determine whether this sector is suitable to you or not suitable to you. But of course, during this period, whatever REIT you buy, you cannot expect any good dividend payout, because the dividend payout will be very pathetic. Okay, it's insignificant. So dividend payout should not be the focus for the time being. You should focus more on the valuation and also future growth. Okay, what my view on the recent EC World REIT. Okay, EC World, if you read the announcement in detail properly, even the investigation that said that this has nothing to do with the EC World. Okay, you just look back to the price action when the news come out. Okay, basically the investor does just sell first and ask question later. You can see that that's why I think EC will drop about 20% in one day. I cannot remember what was the percentage. It's a huge drop. Then after that, the next 2 or 3 days after that recount rebounded immediately. Okay, if you read detail in the news, okay, they have already discounted nothing wrong with EC World fundamentally and also all the accounting. Okay, the investigation is only on the CIO. Okay, I think Lin Jingbo. Okay, uh, I don't know want to speculate on those things. So it's only on the employee. It's not the ECV itself. Okay, I'm sorry. Some of you asking very specific question. Is this REIT good to invest? That REIT good to invest? Like just what I say. It's very much depends on your risk profile, your investment horizon. What do you want to achieve? Right? If you want to, I can only give you a specific answer. If I know your personal risk profile and also your objective first before I can make any recommendation. If you really want to ask specific rate or you want me to give so-called the stock tips and those things, I will suggest that you go into the advisory mode. Okay, I can share with you what to buy, what price to buy, when to go in. Okay, I can do a lot more things for you. Okay, so that you don't need to do all this kind of work for you. Okay, commercial REIT moving forward. Just now I have already mentioned probably will be the office itself. And at the present moment, actually the office REIT they are still undervalued. The most overvalued REIT basically is come from the industrial sector. I'm referring to those big cap REIT, right? And especially for those US REIT, for example, Prime US REIT and also Manulife US REIT. If you read the reasoning business update, actually they are not impacted very much by the COVID-19. They are still holding pretty well. Okay, so you all can take a look into those things, but of course you have to do your own study. Things may change very drastically. So I strongly advise that if you are interested into invest in REIT, just pay attention to this quarter earnings and read through in detail to see what's the impact, because the last quarter would be the worst quarter happen into the REITs, right? If they are financially and also in terms of balance sheet, they are strong enough. If they can survive the last quarter, I think moving forward, probably things will become better. Okay, some of you asked about a 500% REIT portfolio. I don't invest in SIFE. I do not have any comment on those things. Okay, but just take note that when you use a robo advisor to invest, basically they have an algorithm. Okay, it's not like a human advisor. For example, for me itself, when I do all the analysis, personally, I will not going to invest in those overvalued REITs, and also financially they're not sound. Okay, because I don't purely use the data, the past data, to make an investment decision. I will look at what the so-called REIT managers say, what will be their future trend. I always have a future outlook and also my own view, which REIT will do well, which REIT you go for the merger and acquisition, which REIT you go and continue to expand into their portfolio, to grow their portfolio globally, and which REIT you be potentially to be included in the index. For example, Mapletree Industrial Trust recently just included in the STI index, and also some of the REIT will be included in the global REIT index. Basically, robo-advisor is not able to tell you all this kind of forward-looking information. The robo-advisor, they're always based on past data to really, or the current data to really construct the portfolio. So it's very different. So Dot asked about, is there a minimum AUM that help with the portfolio? If you need to have a minimum portfolio, you just drop me an email, because I need to understand your situation first to see whether I can help or not, right? And also need to align the expectation, right? Because at the end of the day, after talking to you, understand the risk profile, maybe the final conclusion is REIT investing is not suitable to you. If REIT investing is not suitable to you after my assessment, then I can't really help you a lot. Okay, so talk to me, write to me, and so that I can recommend a suitable portfolio to match your needs and also your financial objective. Okay, I think Bell asked about if I'm holding Keppel DC REIT and Mapletree Logistic Trust, and both are at historical high, should I sell and buy cheaper REIT? Okay, I will not give you a specific answer, yes or no. Okay, basically at the end of the day, still need to look at your objective. Why do you want to invest at the first place? And how long do you want to hold? And also at what price? At what price you enter? And what is the yield on cost? For example, if your yield on cost is about 8%, right? You are planning for your retirement, holding for next 20 years, and you're holding the REIT with very strong sponsor and very minimum volatility, and those REIT are still growing strong. Okay, and really does not really make sense for you to really sell if you do not have any other better choice. Because just bear in mind that, okay, for other investors, just bear in mind that whenever we want to sell a REIT or take profit, the next immediate question you have to ask yourself, is there any other better opportunity with the similar profile and a lesser risk for you to invest? Because after you sell, you immediately face a reinvestment risk, right? By either switching to the wrong REIT, which has a weaker fundamental, or there's no really strong so-called strong performance moving forward. So those are risks you have to face. So if you are not able to answer those questions, you are not very sure why you want to sell at the first place, probably you might need to hold it. Okay, of course, every year you should do the annual review and also rebalance the portfolio accordingly. Okay, M asks about how do we compare the dividend for the REITs and also the blue chip stock. Okay, basically REIT itself, in order to have a tax transparency, they have to distribute more than 90% of their net property income and pay the dividend back to the shareholder. Okay, that is mandatory. For the blue chip stocks itself, there is no such requirement. The dividend payout is very much depends on the payout ratio determined by the management. The management can determine to cut a dividend if they want to reserve cash for other use or want to reserve cash for acquisition or future growth. So if you are looking for a stable passive income or stable dividend yield, dividend income, I think REIT is a better choice. Okay, because blue chip stock do not offer that kind of so-called guarantee or more stable income. It's very much depends on the management how much they want to pay the dividend. Okay, Albert asked about how do we value the hospitality REIT when you do not know when the travel will be normalized. Okay, the key valuation you'll be look at the price to book value. Okay, and compare historically. Okay, I can show some example. Okay, I show example how to determine the price to book historically. Okay, based on historical value. Hey, Richard, you still able to see my screen, right?
No, you need to take back control.
Okay, I need to take back control.
Yeah.
Okay, I use CDL Hospitality Trust as an example. Okay, by the way, this is not a recommendation, just a disclaimer first. Right? Okay, this is the page to show all the CDL H trust or all the fundamental value. Okay, fundamental ratio, yield, gearing, price to NAV, and the lease management. There are a lot of things to monitor and also do the evaluation and also how they manage the debt. And at the same time, we also can see that where are the location of the property, right? How to determine whether it's a good time to buy? We need to look at the historical data. Okay, for CDL itself, price to NAV at the present moment, you know the average is trading about close to 0.97. Okay, at the present moment, it's about 2 standard deviation away from the average. Okay, so you use the price to NAV, looking at historical data to see whether it's a good time to enter or not. Okay, and also compare to the trailing 12-month dividend yield to look at where are we. Okay, is it under the lower band or at the higher band, and look at the yield spread to see whether it's attractive to enter. Okay, and also look at the past gearing ratio. Okay, and in this example, actually the gearing ratio for the CDL Hospitality Trust actually is going up. Okay, so there are many things to do the evaluation to determine this is a right REIT to invest. Okay, I continue to look at those questions.
Can I take back the screen first?
Okay, take back. Okay, Vincent asked about what is your view of emerging REIT. Okay, during this period, the REIT, in order to compete globally and also diversify globally, they need to be included in the global index. In order to be included in the global index, they need to have a certain size of market capitalization. Okay, that is one of the reasons that why REITs you go on acquisition and merge with each other. Okay, that's the first reason. Okay, second reason is with a bigger market capitalization and with the bigger REIT portfolio itself, they have a better negotiation power to negotiate a lower cost of borrowing. Okay, because size does matter, right? If they are able to negotiate a lower cost of borrowing, basically this will help them to reduce the interest expense. At the same time, they are able to increase the so-called the dividend yield. Okay, and also during this period itself, some of the REIT has already going up a lot and it's quite expensive. In terms of yield itself is pretty low. Okay, and this is a very good chance for them to look out to acquire more property at a very low cost of borrowing. At the same time, most of the property they acquire, they are yield accretive. Okay, that will also enhance their yield. So it makes a lot of sense for the REIT to go for the M&A to make their portfolio become bigger and bigger because there are a lot of benefit. Okay, Joe asked about what is my charges on one-on-one session to rebalance. our rojak portfolio. You talk to me because I need to see whether you're rojak or not necessarily rojak lah. Okay, I see what I can do. You can write to me. Okay, George Tay asks, do you personally see another crash that is as severe or more than last one in March? Okay, just as I mentioned already, now what we need to watch is the whether the bankruptcy, how controllable are these bankruptcy. That's the reason why all the government coming up, all the stimulus package and all the rescue package to really hope to slow down the bankruptcy and also to make sure everything is under control, right? As long as under control, I do not see any crash is coming. But this thing, the default, if totally out of control, you end up more and more so-called bond default or in the capital market itself, and there may be another crash is coming, right? So it's very important. We need to watch the corporate debt, whether the default rate, whether they are under the is whether under control. So that's the thing we have to watch. Okay, I'm watching it so far so good, but we also can see some of the bonds start to default. But so far there's no no significant default yet. That's why this quarter and also second half of the year is very, very important, because for those business and whoever can last, they already more or less they already drain out all their saving. Probably they have maybe 3 to 6 months cash to really last emergency fund or reserve cash to really go through this COVID-19 period. Maybe probably they have used up by now, right? If they use up by now, if the cash flow is still not coming in, the customer still not paying them, just imagine if their customer go bust, all the account receivable will not be cannot receive any cash from the account receivable, right? But at the end of the day, the company still have to pay the supplier, pay the employee, pay the renter. If they are not able to pay those things, they have to declare bankrupt. Okay, so it's very much depends on the whole ecosystem. Okay, Albert asks, do you expect a massive rental default in retail when the COVID 10 bill end? There may be a danger because at the present moment, because the bill prevent the creditor go and really sue those company who is not able to really pay the renter or pay any debt, okay, during this period. If they are not able to resolve a cash flow issue when the bill end, right? I think everybody will go out and to sue each other. Okay, that's my personal view, because under the default case itself, whoever lodge first, whoever has a priority. Okay, that's why we need to keep an eye on those things. Okay, quite a number of you asked about data center. Okay, this is my view. Data center sector is the most resilient sector during this COVID-19, and moving forward is expected data center to be do well. Okay, the key thing is basic investing 101. You don't buy something at expensive, no matter how attractive is the story. Okay, how sexy is the story? You don't buy anything expensive, because if you buy anything expensive, you will have a high probability of losing money, because everybody, or especially all those professional investor and also fund managers, can see that, okay, this sector has already overvalued. Okay, they will take profit and sell by selling the maybe data center, and they'll switch to another sector which is undervalued. Okay, this portfolio rebalancing happen all the time. So for the data center which is already very expensive, you just to be have to be very cautious. Can it continue to go up? It may be, because if you look at the dividend stability, okay, data center, the weighted average lease or expiry is they are pretty long. So in terms of the dividend payout, basically they are pretty consistent, will not be impacted. This is very suitable for those retirees who really want to have a stable dividend. Okay, but moving forward, I am seeing more and more data center to be added in the Singapore portfolio. We have already seen that actually Maple Tree Industrial Trust, they start to acquire data center in the portfolio. Ascenders have also some data center. The next one is based on, I think, today news or yesterday news. Cromwell European REIT, they also start to look at the data center in Europe to be included in their portfolio. So data center is a next sexy story. So keep an eye on that. Okay, and especially during this COVID-19, actually, you also speed up all the technology digital transformation. So data center is expected to do well moving forward. That's the reason why technology sector all doing well currently. Okay, Jia Yi, you mentioned that you were my past student. Okay, no problem, right? You just drop me an email, right? And I can verify you through the Facebook the group. Okay, I know you. Okay, for those uh investor who are asking for the retail and hospitality sector, I just want to give you another perspective for you to consider, right? The current price weakness for retail and hospitality, they are only temporary, because during this period all the business are affected, their dividend are being cut, because when a dividend being cut and their business are affected, and on the fund manager point of view or analyst point of view, normally when they give buy or sell rating, their time horizon is looking for 1 year. Okay, if your time horizon is 1 year, you just want to go in quick and after receive dividend and sell. Okay, not recommended to go in the retail and hospitality sector, because it's you don't expect any good dividend payout during this 1 year. But if your time horizon is 5 years, right, you have to think of it, will this COVID-19 last for another 5 years? Okay, or maybe 1 year later, 2 year later, do you think the COVID-19 will go away, or will the vaccine being found, or everything will become normal again? If you have that kind of long-term horizon, all right, you can start to consider the retail and hospitality, buy at cheap, and also the buy at the price at a huge discount, and just endure and ignore all the noise. Okay, you'll be listening, you'll be hearing a lot of noise. You look at a share, if you're looking at share price every day, you cannot sleep well, because you'll be going up and down, and so if you want to play retail and hospitality, buy, hold, close your eye, and just wait for the whole thing recover. But of course, more important thing is you have to buy the right one, the fun, the strong one. Don't buy another one that actually maybe have the risk of bankruptcy, or all sort of default by the tenant itself. Okay, JQ asks, are we going to expect another REIT sell down during this earnings season, like when and REIT announced withholding dividend in April? Okay, based on chart, no sell down. Until the sell down, I'll tell you. Okay, because I don't speculate what is moving forward. I see what is happening in the market. I look at the stock chart to make my decision. I don't speculate. I don't guess. I don't think. I don't feel. Okay, that is very important when you come to the REIT investing. Focus on fundamental and buy at cheap. Know what you're buying, and also focus on the objective. So for those investors who always want to time the market, okay, my advice is don't waste too much time to time the market. You cannot get it right. Okay, even myself, I also cannot time the market 100% right. I can only determine the trend, and also buy something at cheap. Okay, so time in the market is more important than time the market. Okay, quite a number of you asked about first REIT. Okay, my view on first REIT. Fundamentally, first REIT, they are strong if you look at all the numbers itself. But unfortunately, first REIT, they have a lot of negative news, right? Especially all the news from the sponsor. Okay, and first REIT came out to deny. Okay, because the sponsor they talk about, okay, they are still and stop those some of the lease arrangement. But if you look at it, lease agreement is a legal document. You cannot just come up to the public, just announce, and you can terminate the lease. You cannot just do like that. And the lease expiry, I think the lease you still have about 1.5 years to go, something like that, a minimum 1 year to go. And if they want to restructure the REIT, I believe that first REIT manager itself, they have enough time to really negotiate with the sponsor. That's first way. If they are not able to negotiate with the sponsor, they have 1 year time. They can go direct to negotiate with those clinic, to those doctor who rent a space. Okay, that means it's a direct leasing. So at the present moment, at the current price, there are no surprises because whatever news, bad news, have already priced in. Okay, I think that if they are, you just think another way. If the stock price already priced in all the negative news, okay, if first REIT is able to restructure the list and the good news come up, okay, what would be the stock price reaction? Okay, this one is for you to make your own judgment. Okay, that's my view. Okay, WJ asked about seeing how volatile the market now. Is DCA strategy recommended for REITs? Okay, unfortunately, DCA for individual REIT may not work well. The reason being is because when you DCA, for example, if you DCA $1,000 per month, you want to have a very diversified portfolio of maybe 5 REITs or 10 REITs. $1,000 per month cannot do a proper diversification because it's impossible to buy 10 REITs in just with a 1,000, because you end up you're paying higher commission. At the same time, you'll be having an odd lot, right? So in order to use a DCA for REIT itself, the better approach is you can go with a unit trust. Okay, because there is the REIT unit trust for investor to invest, and REIT unit trust offer you a very good diversified portfolio. At the same time, you can use a DCA at a very so-called cost efficient way, right? Okay, Ben asked about what are the advantages and disadvantages of investing in REIT versus investing in property counter like Capital Land, Hong Kong Land. Okay, property counter, normally how they make money is they buy a land. After that, they go and build a building. After that, they sell it. This is how they make money. Or after they build out the building, they go and rent it out, collect rental income. Okay, and they are capital intensive. They need a lot of cash to really do all sort of development work. And because they need to have a lot of cash flow, not necessarily they'll go and pay out the consistent dividend, right? So if you want to play capital gain, I think that the property counter, the developer, you'll be a better play. If you want to have a consistent and also regular dividend payout, okay, S-REIT is a better choice. So it's very much depends on your objective. Your objective, you determine what kind of counter you should invest in. So every before any investment, we also always need to understand our objective first. Okay, M asked about Cromwell European REIT in Euro and Cromwell's SGD REIT is the same investment portfolio. They are the same. It's only thing that you're buying a different currency. Okay, Jen asked about there are many shops in the mall starting to close down. Will it impact negatively to the retail sector in the next 2 to 5 years? Okay, it depends on which shopping mall you are referring to. So I would suggest that to answer this question, you may go down to a different shopping mall to physically look at yourself, right? Don't read all those the headline news. Okay, if you walk around Orchard, of course, you are seeing many shop in the mall in the Orchard are closing down, because I personally go and walk there. I can see that actually there are a lot empty malls, right? But if you walk around on those suburban mall, okay, depends where you stay. Okay, for example, Junction 8, uh, North Point, Causeway Point, Tampines Mall, you can see that although there are some shops are closing down, okay, but maybe very soon there will be open with another so-called tenant again, right? Because the REIT manager itself, they're actively really looking for the new tenant and also new business into the mall itself, actively managed. And at the same time, as long as you have the traffic and you have people visiting those malls, especially on the urban mall, I think that those empty shops will not be left too long. Because in Singapore itself, basically no place we can go, especially during this lockdown, right? First of all, we want to go travel, we cannot travel. Then where can we go? The only place we can go is actually mall for the time being. There are no other places we can go now. Okay, may I ask about, does my cost cover REIT in overseas exchange like US or China or those listed in SGX? I only cover the SGX REIT, but for my advisory, I cover Australia and also cover the Hong Kong REITs in my portfolio advisory. Richard, what's the time now? Time check.
Now it's 9:47, so I think we can go on for another few questions until about 10:05, because I think the attendees, the friends who attended, and they have questions, and let's try to address as many of them as possible.
Okay, sure. Okay, one of the question asked about the Cromwell REIT, whether the current price has price in the data center. Based on valuation, I don't think so. Okay, this is just my personal opinion. Okay, by the way, after they announced the data center, the price had to move up for the Cromwell, right? Because the data center is not included in the portfolio yet. They're just it's only the news release. Okay, so until the data center is included in the portfolio, they'll be revalue their portfolio valuation. Okay, Gig asked about what advice do you have for a first-time REIT investor intending to set a REIT portfolio? Okay, if you are first-time, first question is depends on your portfolio size. For example, if you are just newly graduated, you only have about maybe $1,000 to spare per month. There are two ways. One way you save until maybe $5,000, then you pick one or two REIT to invest. Okay, because you also need to take note on the commission. In Singapore itself, if you want to buy a REIT itself, the commission is 25 plus. So it does not make sense to go and use 5,000 to go and buy 10 REITs, because you end up you're paying a lot more higher commission. So just if you have 5,000, just two REITs. Okay, that's one way. The other way is you can consider to invest in ETF, REIT ETF. There are 3 REIT ETF in Singapore, or you can invest in the REIT unit trust. Okay, that will be a better approach for the first timer, because with minimum amount, it allows you to diversify as quickly as possible to minimize the risk. Okay, because if you are the new investor itself, the last thing you want is you choose the wrong REIT to invest, and after that the REIT got problem, then your whole portfolio will be impacted. Okay, Xiong asked about the current S-REIT, the FTSE REIT index. The ratio is currently at 1. Is there any website for us to see the historical S-REIT and PB? Okay, unfortunately, there are no website to show you the FTSE REIT index in the daily mode. Okay, but there is a monthly report from SGX website for you to look at the FTSE REIT index PB ratio. And occasionally, we also can see the PB REIT ratio from some of the analyst report. Okay, RW asks, generally, is the yield for REIT unit trust lower than the exchange traded REIT? Generally, no. The unit trust normally has a higher yield than an exchange traded REIT. The reason being is unit trust is actively managed. There is a fund manager behind that can allocate and also they can do the switching to those REIT to which offer the higher yield to optimize the return. For the exchange traded REIT ETF, basically they are passively invest, and normally ETF they are dominated by all those big cap REIT. Okay, and most of the time big cap REIT they are expensive and the yield is pretty low. Okay, some of you ask, some of the REIT are very good, okay, very fundamentally strong, but they are overvalued. Should you continue to accumulate? There's no right or wrong answer. It all depends on your strategy. Okay, personally, for my own investment and for my own advisory, I will not touch and I will not invest those overvalued REIT. Okay, that's my own rule, right? Unless those overvalued REIT they have very strong and also very visible growing plan or very good new portfolio acquisition to offer the huge future growth, then I will start to consider. Okay, is there a way to buy REIT on a dollar cost averaging method? So some I answer already. Actually, yes. You just need to look for those broker who offer the REIT unit trust or REIT ETF, or you also can buy the individual REIT itself. You open an account with them, and after that you can just do some structure. Okay, you need to look for the right broker. If you do not know which broker to look for, you can write to me. Okay, I can recommend you. There are a few broker that are able to offer this kind of solution. Okay, you can write to me. Okay, Vincent asks, for merging REITs, understand it's always the bigger REIT acquire the smaller REIT. Is this determined by the market capitalization? Normally it's the case. How we determine which is a bigger REIT and which one is a smaller REIT? Normally we use a market capitalization for a quick so-called comparison. Okay, another thing to consider when you all invest in REIT itself, you need to look at a number of portfolio. Okay, if some of portfolio only got 2 portfolio, for example, if during a lockdown period and majority of the rental income actually come from retail, definitely the rental income will be affected. But if your REIT have 100 property around the world, in terms of diversification, it's impossible all the 100 property being locked down. Okay, so they are at least in terms of the diversification side and also rental income, it is more certain. So the lesser the portfolio, okay, 2 or 3 portfolio, you have a higher probability. If the second wave come and continue to lock down, then your rental income will be affected. Okay, and those REIT probably you have, in terms of price, you is much more volatile. Okay, is Capital Mall Trust considered as a suburban mall, a big combination? Okay, because Capital Mall Trust also got Junction A, Plaza Singapura, Bugis. They are mixed. Okay, it's not considered 100% suburban mall, right? The 100% suburban mall referring probably to the Fraser Center Point. Oh, he can ask about my collaboration with the stock cap. Okay, interesting. Okay, when I doing my REIT analysis, I find that is too tedious because the data keep moving. That's why one day I actually stock cap come and look for me, and we explore the idea how to collaborate. That's why I share with him this idea. Again, since I am teaching, and I'm also using subscribing the different REIT screener for my own analysis. Unfortunately, until now, I'm not able to find a REIT screener to really serve all my objective, have all the data available and also updated. That's the reason I propose to StockCap. Okay, I want to customize a REIT screener really specialized for REITs. Okay, so it's more relevant for the analysis and also to help my own analysis. But of course, by building this REIT screener, you StockCap itself. At the same time, I also told StockCap that can offer to public. Okay, of course, we charge by subscription because we need a lot of time to really maintain it. If you look at all those data itself, basically they're all manually enter. I have to go through all the 41 REIT in Singapore every quarter and update every quarter. I have to read through all the earning result to extract all the data. That's why a lot of work. But using the stock cap risk screener actually can speed up a lot of and also shorten a lot of time in terms of evaluation. It's really saved me a lot of time. Okay, JT asked about for REITs, they are available in both SGD and in local currency. For example, Cromwell. How do we decide which one to go? What are the considerations? Is it better for Singaporean to buy the one in SGD? It depends on your preference, right? If you have the option to choose foreign currency, you need to look at the forex trend. Okay, for example, Elite Commercial actually they offer in British pound. Okay, Cromwell offer in euro, right? You have to decide. At the present moment, whether Sing dollar is stronger or euro is stronger or British pound is stronger. Okay, it all depends on your investment horizon. Okay, for example, if you have view that in the next 10 years, right, British pound you back to the previous level, you'll be much more stronger than Sing dollar. At the present moment, it's better to use a Sing dollar to buy the weaker currency because besides getting a dividend, you also can have a capital appreciation. Okay, that's one point. Then the other thing is if you think that you do not like the volatility of all those forex, okay, because it can go up pretty you can appreciate and also can depreciate. You do not like the volatility, then you stay with Sing dollar. Especially you need a Sing dollar for your monthly dividend payout, so that you can minimize all the forex fluctuation. Okay, my view with those REIT, China and Hong Kong exposure. Okay, I personally moving forward, China will be open now, and there will be more and more REIT to be listed from China, or even China you have their own REITs. Okay. At the present moment, because of the legislative framework is not ready in China yet, that's why they are not very popular. Now, if you just imagine when the REIT become more and more popular in China, they are getting more and more people understand how the REIT work, and more China investor coming out, right? Probably they'll invest in something they are more familiar with. Okay. Okay. In short, I have a bullish view over the long term on the REIT listed in China. Okay, just a personal preference. Of course, during this period, of course, there are risks. Okay, there are a lot of risks in China itself. Okay, because a lot of things we can't really control. Unlike those REIT in Singapore, we can feel it, you can see it, we can already shop around to see how the property looks like. We can feel the traffic, and we also understand the local government how it works and those things. But once a REIT listed in overseas, once the REIT has an overseas property, basically is how we do analysis is basically we're just reading the report. Okay, everything is just based on what we read and what we see. It's not what we feel and what and on physically down there to really pay a visit. Okay, I think 10 o'clock now. Okay, I will answer the last two questions, all right,
Yes,
so that
that's
we
right.
don't overrun.
Correct.
Okay, W. Tan asked about how many REIT do you recommend in a portfolio? Better to focus on certain strong REIT with a high market cap or diversify in more REIT? Okay, it's come back to your own objective again, right? Depends on your risk profile. If you are the high risk taker and also you prefer higher yield and also looking at the technical to maximize the return, right? You can have more REIT. Put in more REIT which have the so-called higher volatility. Okay, but higher volatility means that the risk is higher lah. So in general, when we build a REIT portfolio, we have to determine what are the REITs we want to put in as a core portfolio. Core portfolio, that means that when we construct this portfolio, basically we are whole, we buy whole and collect the dividend and let the time and let the compounding effect do the wonder. Okay, that's a core portfolio. Normally, the core portfolio is about 70% of the total portfolio. Okay, and 30% basically is a tactical. You can invest in those REIT based on technical analysis, or you or have a huge sell down due to negative news, and to optimize return. So you can allocate no more than 30% for the tactical play. Okay, Joe asks, is it better to buy REITs and hold under own CDB account? Any concern if you buy REITs under custody? Okay, if you buy REITs under the CDB account, definitely whenever there's a corporate action, you will receive the letter directly from the REIT manager. Okay, so especially when it comes to the, you need to make certain decision on, for example, DRP, dividend reinvestment plan, or you need to subscribe the new rights. Okay, CDB you give you the much faster response. But if you hold your REIT under custody, okay, just pay attention. Sometimes the custody when they are late in sending those letter for the investor to make a decision, you may miss out some important decision to make. Okay, so if you're under the custody, just need to make sure you select a good custody and they are responsive and to inform you if there's any corporate action. All right. Okay, so Vincent, last question. How can retail investor participate in the private placement? Okay, in short, unfortunately, retail investor has no chance to participate in private placement. No chance. Okay, private placement only offer to those accredited investor. If you have a private banking relationship with a certain bank itself, you may have a chance to be invited to participate in those private placement. Okay. I
Okay,
think that's
thanks
all.
a lot, Kenny. Yep.
Yeah,
Wow.
thank you.
That's almost like 40 to 50 questions that Kenny have answered in one breath. Okay, wonderful. So just a last point to shout out to everyone who are still with us, about almost 400 of you here. So if you have not already joined Kenny's Telegram channel, please go and join it so that you can be kept posted of his nuggets, insights, and also his upcoming webinars or courses, if any. And if you'd like to be kept posted about OTCS workshops and webinars, please join OTCS Telegram channel by searching for Online Traders Club. Okay, for Kenny, it will be Retirement, REITIREMENT. And with that, I thank everyone for your participation and your time. And again, Kenny, thank you very much for this webinar. A very good update for phase 2 and also beyond. So I look forward to the next webinar with you. Okay, so good night, everyone, and please take care.
Okay, good night. Bye bye. Take care.
Bye.